Hello there, and welcome to the Kluge Wealth Advisory Group's wrap-up video for November and December. In this month's video, we're going to cover off a number of topics, including a quick personal update from me, a monthly market summary, a monthly portfolio summary, as well as some answers to your frequently asked questions. And as a quick reminder, all of our content is available online all the time at our YouTube and X channels. Let's jump right into it. As we get into things, I just wanted to take a moment to extend myself and my team's warmest wishes to you and your loved ones for the upcoming holiday season. I hope it's filled with joy, love, and laughter. Unfortunately, due to the Canada Post strike, we're unable to get out our usual holiday cards at this time. However, I did want to communicate that, per usual, and as per last year as well, we have made a $10,000 donation in lieu of gifts to the Calgary Children's Cottage Society. They've let us know that that donation will cover approximately the purchase of 38,000 diapers. So we know that we're able to make a positive impact, and of course if you have any questions about the Children's Cottage Society or would like a tour, please let us know and we can make some arrangements there. Before we jump into the meat of today's call, I want to give everyone a quick personal update. As some of you know, but many of you do not, I recently suffered a bout of appendicitis and resulting complications that left me in the hospital for 8 days. I am feeling better now and my energy is returning, and I'm looking forward to getting the job done as we get into 2025. I also wanted to take a moment to thank each and every client whose calls or meetings were disrupted by my illness for your well wishes and understanding. Thank you very much. It means a lot and we really appreciate that. I also want to take a moment to thank Kyle, Jordan, and Scarlett for holding down the fort while I was gone and making sure that the wheels kept turning and that client service kept up. Thank you very much to the three of you. I can't do it without you. Now, let's get into the meat of today's call. In terms of a monthly market update, November was a pretty straightforward month. The equity market rallied substantially following Donald Trump's decisive win in the US election. In this rally, we saw both growth and value styles perform very, very well and similarly. So it was a very broad-based rally, and from that perspective, very, very healthy. In terms of fixed income, not a lot of change over the course of the month. There was an initial uptick in yields as Donald Trump was elected. However, as the market gained comfort with his choices for his cabinet, yields gradually retraced their rise. In terms of commodities, there wasn't a lot of change. Some commodities nudged up, some commodities nudged down, but if you took a look at the chart for the Bloomberg Commodity Index, you'd see not a lot of change. And we're back. In terms of a portfolio review, I'll jump right to the bottom line and just say that November was a very, very strong month, and in many cases, the strongest month on record in the last couple of years for portfolios. Now, in terms of things that happened, we did make one adjustment in adding an ETF that covers off the US financial sector, including the majors as well as what we call the super regional banks. Now, the US super regional banks, in many cases, are very, very large institutions, some of them larger than Canadian banks like BMO or Scotia. Now, one more thing to note for the portfolio is that we will be doing our usual annual rebalance in January. And we're doing this because as part of rebalancing, we're going to be triggering a certain number of capital gains, and we want to delay that reporting into the 2025 tax year, with taxes due, of course, in April of 2026. Now, in terms of what that rebalancing will look like, as you look at your statements through January, you will notice that generally equities are being reduced with increases to purchases of fixed income and alternative strategies. All right, let's get into some of your frequently asked questions. And the number one frequently asked question, to nobody's surprise, over the course of November and early December here, has been, what's your take on an incoming Trump administration? Well, the bottom line is that I always want to note first that we always want to separate personality from policy, especially when we're dealing with Mr. Trump. But the bottom line is that I think that the amount of change that could be coming over the next 4 years is commonly misunderstood and underestimated when I'm taking a look at media and news sources. You have a very, very focused administration coming in that's making a very, very big impact in terms of being ready to roll on day one. They're making cabinet appointments very, very quickly, which is going to be key to implementing their agenda. And it's been very clear that their agenda is focused on increasing productivity, increasing growth, and changing the structural nature of the US federal government. Now, to the extent that they're successful, this will help to increase growth, reduce long-term debt, and ultimately continue to make the US a destination for investment capital. So as we see signs of success or not, we will have to, of course, make portfolio adjustments. But this is very clear what their intentions are and the road that they want to try to go down. Another related question that came up frequently over the course of our conversations in November and early December was, how is the US going to be able to deal with its debt? Well, let's put it right out there and just say that right now, the United States' debt to GDP ratio is approximately the same as it was after World War II. So something has to be done. Now, the incoming Treasury Secretary, Bessonette, has a plan based on what's been called the 3 threes, which is that you want to achieve 3% real growth, which is growth after inflation. You want to have a 3% budget deficit, and you want to increase US energy production by 3 million barrels per day. Now, what that really means in effect is that this is the same game plan that they used after World War II to grow their way out of debt. And it works like this. If you have 3% real growth and 2% inflation, that means your total nominal GDP growth is 5%. If you then have a 3% budget deficit, what that means is that your debt to GDP ratio shrinks by 2% a year. Now, 2% a year shrinkage might not sound like a lot, but when you multiply that over 10, 15, or 20 years, it makes an enormous impact in the debt to GDP ratio of a nation. In addition, increasing US oil production or energy production by 3 million barrels per day will also have the effect of keeping inflation low and insulating the United States from energy-related supply shocks, which should also help to keep inflation and interest rates low, which furthers the plan. So there is a blueprint for how the United States can get out of this, and it looks like at this point that they are going to be using the same strategy that they did post-World War II, which is a combination of growth and inflation to take care of the debt. In addition to the Trump-related questions, we also ran into a lot of questions about our outlook for 2025. So let's get right into that. I think fundamentally, and from the biggest picture perspective, 2025 is going to be a good year. I would expect that we're going to get the usual number of 5 to 10% pullbacks like we do every year, but at the end of and when we get to the end of 2025, we're going to look back on another pretty solid year. Maybe not as solid as 2024, but still pretty darn good. Now, I always want to acknowledge certain risks, both to the upside and the downside, and I think that if we're looking at managing risk, which is very important, we have to be aware of two things. The first is that the current optimism in the market could easily turn into euphoria, which could turn into speculative behavior, which we all know is not good for long-term returns and tends to lead to much more significant corrections. And the second thing we have to watch out for is how effective the DOGE department is, or the Elon Musk-led Department of Government Efficiency. If it is able to achieve its goals of cutting US government spending by 1/3, there's a significant possibility that the US could suffer a growth slowdown as that fiscal boost they've been receiving lately wears off. So that's something we also have to watch out for. However, there's no evidence of that at this point, and also no evidence that we've gone into a state of euphoria. Markets are very broad, markets are very strong, and we tend to see performance from higher quality stocks versus junkier quality stocks. So as we go into 2025, we remain optimistic, but always vigilant for all the potential positive or negative risks that are out there.